Decision-making criteria video offered by the Business Certificate series. So within this video, we'll be going over what is decision-making in finance. We will also be going over what are the components of decision-making. We will then do a few examples to help you understand the importance of decision-making in finance. Making a financial decision is the process of weighing the pros and cons of a decision as it relates to the use of money. This can be regarding the acquisition of funds through a loan or the act of spending money on investments or projects. Utilizing NPV, net present value, and IRR, or internal rate of return, organizations can effectively make decisions on how to budget their cash. So what are the components of decision-making? IRR, or as I mentioned before, is the internal rate of return. This is the effective compound rate of interest that can be earned on the invested capital. This is not the same as the interest rate. NPV is the net present value. This is the current value of the future cash flows anticipated to result from invested capital. This is a method of calculating return on investment for a particular project or expenditure. Payback period refers to the amount of time it takes to recover the cost of an investment. This is important as individuals and corporations mainly invest their money in order to get paid back. If the IRR results above the organization's hurdle rate or required rate of return, the project should be pursued. If the IRR results in a number that's below the organization's hurdle rate or required rate of return, the project should not be pursued and they should seek to invest their money elsewhere. If the net present value is larger than zero, the project would be producing positive cash flows, meaning it is worth it to take on the investment. If the net present value results in a negative number, that would mean that the project is producing negative cash flows, meaning it is not worth it. As the payback period is the length of time it takes for an investor to break even, it is apparent that shorter paybacks are more attractive investments while longer paybacks are less desirable. Another piece of decision-making in finance is the profit index. The profit index is calculated as the present value of the benefits over the present value of the cost. This is present value of future cash flows over the initial investment. When the profit index is greater than 1, this would identify that the present value of the benefits are greater than the present value of the cost, meaning you should do it. When the profit index is less than 1, this would identify that the benefits are less than the cost, meaning you should not take on that investment. The relationship between NPV, profit index, and IRR goes as follows. When NPV is greater than 0, profit index is greater than 1. When IRR is greater than the interest rate, NPV is greater than 0. And when IRR is greater than the interest rate, profit index is greater than 1. Going into example number 1. So let's say you invest $500 today and anticipate to get back $570 next year. Using an interest rate of 10%, what is the net present value? So using our HP 10B2 Plus financial calculator, I would put in 10 for IYR as our interest rate, negative 500 for our first cash flow because that's what we're investing today, and then for our next cash flow, we're receiving $570, so I'm going to input that as positive, click the CFJ key, and then when I click red, the down arrow, and NPV, I see that my NPV is 18.18. If I want to see this done out on paper, I can find the present value of the future cash flow, the $570 anticipated next year, and I'm going to take that 570, divide it by 1 plus the interest rate, raised to the power of t, and because this cash flow is coming in 1 year's time, we're going to raise it to the 1. That results in $518.18. Then once we take that and subtract it from our initial investment, we result in the same NPV, $18.18. With this same investment, what is the effective compound interest rate, or IRR, earned on the invested capital? So without doing anything else, I'm just going to click the red down arrow and then click the IRR button, and we'll see that the IRR for this investment is 14%. And this is larger than the interest rate that we used of 10%. And this also shows that our NPV is positive and our IRR is larger than our interest rate, meaning we should do the investment. So you make another investment of $1,000 at an interest rate of 15%. With anticipating cash flows of $570 in year 1 and 620 in year 2. What is the net present value and the internal rate of return? So we're going to go through the same process as we did before. I'm going to input 15 in for the IYR, negative 1,000 for the cash flow 0, because that's what we're investing, that's what we're losing today. Next year, we're going to receive 570, so I'm going to put that as a positive for the next one, and another positive 620 for the next one. And then when I click the red down arrow and NPV, I can see that my net present value is negative 35.54. When I click red down arrow and I click IRR, you can see that it's 12.24. And having a negative NPV and an IRR lower than our interest rate means that we shouldn't take it on. Again, I can see this done out on paper as cash flow 1 divided by 1 plus the interest rate raised to t. Since that's the cash flow we're going to be receiving in year 1, our t is 1. We're going to add that to our next cash flow divided by 1 plus the interest rate raised to the power of t. And since this is coming in our second year, we're going to use the 2 as our exponent. Then when we add those up, we get 964.46 approximately. When we subtract that from 1,000, we get negative 35.54. Moving on to our second example. So you make an investment of $2,000 at an interest rate of 11%. You receive 3 yearly payments of $100 each, plus $2,500 in the third year. What is the NPV and IRR? So we're going to go through the same exact process as before and put 11 for IYR, negative 2,000 for cash flow 0. So I would put in negative 2,000, click the CFJ key for cash flow 0. Then the next year we're receiving positive $100, so I'm going to do 100 CFJ 1, 100 CFJ again for CFJ 2, and then in the third year, because we're receiving an additional 2,500, we're going to do 2,500 plus 100 to get 2,600 and input 2,600 for our third cash flow. Then I'm going to click the red NPV and see that our net present value is 72.35. When I click the red down arrow and click IRR, I can see that our interest rate, or our internal rate of return, is 12.38, higher than the 11% interest rate. Again, you can see this done out on paper. It's cash flow 1 divided by 1 plus the interest rate raised to the power of t, or time, plus the next cash flow, same deal, plus the third cash flow, which is the 2,500 plus the $100. When you add all that up, you get $2,072.35. Subtract that by our $2,000 initially invested, and we get 72.35, the same as what we calculated. So our third and final example. If a company were to invest $300,000 on a new production line, they would need to determine how much cash flow will be produced as a result of the new production line. Assuming the company expects positive cash flow of $100,000 per year from the production line, what is the payback period? In order to find the payback period, you can simply divide the initial investment by the future cash flows. Initial investment of $300,000 divided by the $100,000 per year means it would take 3 years to get paid back or break even. That's it for the decision-making video. Thanks for watching.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.